Are you absolutely terrified of holding a stock right as the underlying cash flow completely dries up? Well, stop what you're doing. If you own or even just looking at agricultural stocks, you really need to hear this. Welcome to this explainer where we're going to decode a massive mystery inside the Anderson's Q1 2026 earnings report. You see, last week I ran this exact report through our fundamental analysis framework and two legendary checklists, and honestly, what I found hiding in the margins completely shocked me. By the end of this explainer, you'll know exactly whether this massive earnings beat is a classic Warren Buffett value buy or a dangerous Peter Lynch value trap.
Okay, let's dive right into the data. Year over year, the company's top-line revenue actually dropped by roughly $30 million. We're looking at $2.63 billion in Q1 of 2026 compared to $2.66 billion back in Q1 2025. Now, usually, a shrinking top line makes Wall Street incredibly nervous, right? Because, well, it can be a huge early warning sign of a stalling business.
But here is the crazy part. Despite that drop in revenue, their diluted earnings per share absolutely skyrocketed. I mean, we're talking about a jump from a mere penny, just 1 cent last year, to a massive 97 cents per share. That is a shocking contradiction. The top line is shrinking, but the earnings per share went completely parabolic.
And this right here beautifully illustrates our core mystery for today. How on earth did net income jump from just $300,000 to over $33 million? And how did adjusted EBITDA climb from $57.3 million to over $91.5 million, all while overall sales shrank? It's literally like finding a hidden gold mine inside a shrinking property. So we're going to use a clear, actionable framework to figure this out step by step.
Section 1. Agribusiness holds its ground. To solve this puzzle, we first need to look under the hood at their traditional agribusiness division. It turns out, returning market volatility actually provided some pretty resilient opportunities for their merchandising businesses. They brought in $7 million in pre-tax income and a really solid $18 million on an adjusted basis. Now, compare that to a $10 million loss last year. According to CEO Bill Kruger, as prices rallied, a lot more old crop bushels came to market. Plus, they saw improving fertilizer margins because they strategically positioned their products right ahead of spring planting. So agribusiness is definitely holding its ground for sure, but it doesn't even come close to fully explaining that massive earnings jump we just talked about.
Section 2. Renewables and the big reveal. To find the actual source of this quarter's massive earnings beat, we have to transition over to the renewables segment. Putting these two divisions side by side, it is overwhelmingly clear that renewables did the heavy lifting for the bottom line here. Agribusiness brought in $7.4 million in pre-tax income, but renewables, they delivered an absolute powerhouse performance of $39.6 million. That is a gigantic leap from the $24.9 million they reported in the exact same segment a year prior.
So the bold, burning question we have to ask ourselves right now is this: where exactly did this massive renewables profit come from? Especially when overall sales were down and they were actually facing higher natural gas expenses.
Well, the crucial piece of the puzzle is this incredibly surprising number, $26.2 million. That entire amount was generated purely from Section 45Z clean fuel production tax credits. Just think about that for a second. The vast majority of their renewables profit increase came directly from a government tax incentive. Now, what's really fascinating is how they actually managed to secure that money. By hitting record ethanol production and operating their plants incredibly efficiently, they qualified for a higher tier of these new 2026 tax credits. Add in strong ethanol demand, higher distillers' corn oil, and higher RIN values driven by biofuels policy benefits, and boom, you get a massive influx of pure profit dropping straight to the bottom line. Honestly, it's a brilliant operational pivot.
Section 3. Under the Hood Risks.
Now, before we go declaring this a flawless victory and call it the greatest stock on the market, we have to impartially examine the bearish signals hiding a bit deeper in the balance sheet. Because while profits surged on paper, actual cash flow tells a much more cautious story. The company used almost $394 million in operating activities, mostly from working capital movements. At the exact same time, short-term debt climbed really aggressively to over $716 million. And cash and equivalents? Yeah, they are down 67% year over year to just $72.4 million. It's a stark reminder that net income on an income statement and actual cash in the bank are two very, very different things. Building on that cash crunch, they actually amended their credit agreement, reducing their revolving credit facility from $1.55 billion down to $1.30 billion. They also restructured an $86 million term loan, pushing it all the way out to 2034. Now, this gives them some breathing room, but it absolutely keeps the leverage on the books. On top of that, there's a $5 million hit for a legal settlement accrual related to a putative class action. These are exactly the kinds of balance sheet realities that require a really careful objective RE. And then there's this. Data pulled directly from Quiver Quantitative reveals that company insiders, the people who know the business best, well, they have sold stock 22 times on the open market in the last 6 months. And how many purchases? Exactly 0. Let me repeat that, 0 buys. When insiders are exclusively selling into an earnings beat fueled by tax credits, it is a data point that absolutely warrants our attention.
Section 4, steady dividends and outlook.
So, with these structural risks in mind, the cash drain, the debt, the heavy insider selling, what is the ultimate takeaway for long-term shareholder returns? Let's look at Sure Dividends analysis, which highlights the company's incredibly resilient 29-year streak of consecutive dividend growth. Almost 3 decades of increasing payouts. That is a massive testament to their historical stability, proving they have survived and rewarded shareholders through multiple commodity supercycles and crashes.
Backed by a highly conservative payout ratio of just 21%, this reliable dividend, which is currently yielding around 1.12% with an annual payout of 80 cents, continues to provide serious stability for investors despite all the agricultural market volatility. They even just recently bumped it up to 20 cents per quarter. So even with the cash flow concerns we just dug into, this extremely low payout ratio means the dividend remains highly secure.
Looking ahead, management definitely isn't resting on its laurels. CEO Bill Krueger has established a really bold target, hitting a $7 run rate earnings per share by the time they exit 2028. That is a highly ambitious goal, and it signals a lot of strong internal confidence.
To get there, they aren't just sitting back on those tax credits, they are reinvesting heavily. They plan to deploy about $225 million in capital this year. This includes expanding their Clymers, Indiana ethanol plant to approximately 170 million gallons and adding crucial soybean meal export capacity down at Port Houston. Basically, they're actively investing in physical, revenue-generating assets to drive future growth and try to hit that $7 EPS target. So as you review everything we've covered in this explainer, I want you to ask yourself this final question. Does the momentum of these clean fuel credits and a 29-year dividend streak make this an attractive hold? Or does the short-term cash drain and heavy insider selling warrant a much more cautious approach? The fundamental data is all on the table. The mystery of the profit paradox is solved and, well, the final verdict is up to you. Thank you for joining me, and as always, keep questioning the data.